Your wealth deserves stability, expertise, security. Your wealth deserves LGT Cresto, private wealth with over a century of global heritage.
Hello and welcome to the Global View on this Monday. Well, let's take a look at what's going on in the macro picture. Longer dated US Treasury yields dropping from 10-month highs on Friday ahead of the Fed Reserve's Jackson Hole meeting later this week. The yield on the 10-year note at 4.25% and the 2-year at 4.93. Fed funds futures traders now pricing in around 110 basis points of rate cuts next year. Meanwhile, a Reuters poll of 110 economists found 90% believe the Fed is likely done with its interest rate hikes, with a slight majority expecting the central bank to wait until at least March before cutting them. And the US dollar was flat on Friday, but notched up its fifth consecutive week of gains, buoyed by demand for safer assets on concerns over China's economy and that US interest rates will stay elevated. The Aussie dollar rising marginally to just above 64 US cents after hitting a 9-month low of 63.6 on Thursday. And China's central bank and financial regulators have met with bank executives telling lenders to boost loans to support economic recovery. The move adding to signs of heightened concern from policymakers about the deteriorating economic outlook in China. Policymakers reportedly also pushed for changes to China's home mortgage policies from lenders, and the request coming in the wake of the bankruptcy filing from major developer Evergrande. All right, well, let's in fact discuss what's going on in China. Joining us now is Dr. Joseph Lai from Ox Capital Management. Joseph, good to see you again.
Likewise.
Yeah, so look, there appear to be two major global issues dominating investors' outlook at the moment. Yeah. That strength we're seeing in the US and where interest rates are going to go.
Yeah.
And almost the opposite is the case in China
Yes.
at the moment. What are you seeing and what are you hearing out of China at the moment that's informing your view?
Yeah, sure. I mean, I think the reality is the transition from an investment-led economy to a more consumption one. It's always going to be a rocky road, and so that's what we're seeing right now. But from our perspective, look at companies from a bottom-up perspective, what we're seeing is that things which are linked to the property sector, I mean, they are looking weak, and in fact they've been looking weak for two years probably. And the defaults that we are seeing, I mean, Evergrande, well, has been a bit of a basket case, really. I mean, for almost 12 months now, and sure, they're declaring bankruptcy in the US. So in a way, the property sector is making a big adjustment in terms of reducing. They need to reduce the number of properties constructed each year, and that's well and truly happening. And what we are seeing is the picture of that. Yep, property side is weak, but when we look at other sectors of the economy, there are actually elements of strength. For instance, if we look at, despite all the talk about the weakness of the economy, which we admit, yep, it is weak overall, but if you look at the number of car sales sold in China in the first half this year, it's actually a record high. I mean, compared to history, and it's actually becoming this year the world's biggest car exporter, overtaking Japan this year in terms of exporting cars. So I guess the more nuanced picture that we're looking at is, yep, big adjustment happening. The property sector is weak and most likely will remain weak. It may recover a little bit with policy change, but it's just the other aspects of the economy, they are actually doing better. And I guess that's where we see the opportunities.
All right, but I mean, as you've mentioned there, just in terms of that weakness we're seeing in the property sector, and also, I guess, markets generally frustrated that not seeing greater stimulus coming, particularly from the PBOC. Yet, as I was just mentioning there, they're looking perhaps for those home mortgage policies from lenders to boost those, to try and, I guess, get some impetus going in the property market. Yeah. But, I mean, is that sort of band-aid measures, or is there something more substantial that they can actually encourage that investment?
I suspect that's all they'll do. I mean, it is. I mean, they know that the economy has urbanized a lot in the last 20 years. In terms of people flowing into the big cities, certainly not as plentiful as a few years ago. So the number of property to be constructed by the private sector need to be reduced, and that's what's happened. I mean, property sales has come down about 50% from the peak over the last 2 years. That's why we're seeing the weakness. But it's probably weakening more than they want. So there is an element of, from by the regulators to relax. They're still very tight property policies in the top tier cities. I mean, it's still difficult for people to buy second properties in places like Shanghai, Beijing, and stuff like that. Interest rates for even first home owners is around 4%, which in an economy with zero inflation, it's actually reasonably high. So they're actually having some policies which they can relax. Real rates is still quite positive in China. And also the administrative restrictions on who can buy properties, who cannot, that can get relaxed. But at the end of the day, though, the aim is not to pump this up back into a property bubble. That the aim is to actually, ameliorate the slowdown per se, I think. So that's what we're looking at. That's the picture we're looking at. Yeah. It's unlikely for them to actually go, let's spend $10 trillion and build all these things. I mean, that's not the game anymore. They know that they need to transition. The transition is always difficult, and that's why last 2 years been all this news about property weakness. But then in a way, a lot of the pain has been had, and a lot of the risks have, in terms of the property market, in terms of the financial system, it's actually more de-risked compared to other economies which are still relying on property. I guess bubbles to actually keep pumping things up.
So, I mean, you mentioned there at the start, particularly what you're seeing with the car market there, that strength. But what is that telling you more broadly, and what opportunities do you see then in China when you look through that gloom more broadly with the economic outlook?
Look, I mean, the reality, the way I look at it is this. I mean, the Chinese stock market is cheap. I mean, it's come down a lot. I mean, literally, clearly, probably for good reasons, there's been a lot of reluctance to want to own those assets, those equities. And so therefore, if you look at the PE ratio, it's multi-year lows. It's factored in a lot of the negativity. Hard to know, whether it can fall a bit more. But the reality is, give it a 3-5 year view, probably is actually highly prospective. And the question I ask myself every day, faced with all this news, right? I ask myself, okay, in 3 to 5 years' time, will the economy be bigger than today? And I guess the answer is most likely, right? And then if I ask myself, if I can buy the leading businesses in this economy when everyone's afraid, and the valuation is very cheap relative to history, relative to global peers, will this business be bigger? Yes. And if you can get them in a valuation that's really attractive, then can I make money? And I think, almost unequivocally, yes, in most cases, but maybe not in all cases. So that's where we're coming from. Certainly, it's hard to know when it's going to bottom, right? But then in terms of long-term investing, valuation, that it is supportive.
More broadly, what are you looking at some of those emerging markets, I guess, when you see the global economy slowing? What sort of leverage do they have?
Yeah, sure. So what we're seeing is actually, as we know, global, developed economy has been raising rates. That's finally leading to some signs of a slowdown. If we look at forecasts of GDP growth in most developed economies, actually going to slow quite a lot, actually, if you look at the forecast. So growth will be in short supply. Interest rate, however, probably comes down, as you mentioned. There's people factoring on US rates getting cut quite a lot next year. Whether it's true or not, we'll see. But that scenario of a lack of growth opportunities globally in developed markets, and interest rate in the US coming down, and potentially US dollar weakening as a result, that is very positive for emerging countries. So we have a few countries we like Brazil, which actually has real rate of about 10% at the moment, which can be cut. Countries like Indonesia, Vietnam, these are endogenous, and India as well. These are economies with strong endogenous growth, together with good export growth as well. Interest rates positive. Real rates, I mean. So they can be cut. Valuation has been attractive, maybe with the exception of India. So we think that's where the opportunities are. Growth with real rate that can be cut, and cheap valuation to start with.
All right. Well, it's not a bad place to start, isn't it? When you're particularly looking at those economies such as, closer to home too, Vietnam, Indonesia, and more broadly. Brazil.
Yes.
Joseph, terrific to get your outlook. As always, thanks for joining us from Ox Capital Management.
Thanks very much.
All right, that is the global view for this Monday. Just before we go, check of the market. We are expecting a negative open here. Of course, we did have, we ended down last week. It was about 2.6% lower on the local market for the week. So expecting another bit of a step lower when we get going in just a couple of minutes' time. So stay with us for the open.